Hi everyone, myself Murugan. Happy to present another interesting video. And this will be a part of investing playlist. And it is really good for someone plan to invest from a very longer term perspective. So as an investor, what happens if you invest in multinational companies? Why specifically I take multinational companies? Because in general, those multinational companies carries a very high PE ratio. And PE ratio is very interesting and integral factors when you invest from a very longer term perspective. And if you look at things only from the PE ratio, those multinational companies may not be in your picture. Why? Because it generally carries a very, very, very high PE ratio. And the concept of PE ratio generally justifies that go and invest in a low PE so that you get a stocks at an attractive price. So we need to know whether to invest in multinational companies or not. And if you are aware of EQSIS Invest, okay, which is the tool which makes the direct investments in equity much simpler, and we after all got one basket which we recommends to majority of people, and this basket is what we got a very high conviction, and that basket of stocks carries a significant portion of multinational companies. The multinational companies that from Indian origin, multinational companies from foreign origin, and of course there may be some companies which from Indian origin doing a local business in India. So we need to know why that excess portfolio gives a reasonable share to these multinational companies, right? Let's get in detail. Try to understand and digest this concept that multinational companies are not just expensive. Okay? They are always expensive. I mean, if something is really expensive today, we can postpone buying that. We can buy a bit later when it become affordable. But when something is always expensive, and it doesn't matter because it is always expensive anytime you buy, or even when you sell it is also expensive. So as a trader I may be buying at 100, and if it become 120, I'm actually making 20 rupees. But as an investor I buy something which is always expensive, so even at my exit I don't have a problem. But we should be very careful of making that is always expensive. That's very important. So not today alone expensive, I can also see that going forward also it remains expensive. We need to know there are certain factors which justifies that. Let's get in detail. Why they are first of all expensive? Number one, they are multinational. See, doing business in one geolocation, that itself difficult with a lot of challenges. But when someone able to get into a cross borders to a different countries with a different cultures with a different government, and if they were able to sustain with multi number of governments, then that is a very interesting business. I'm right. The business origin may be from one country, but they have existence in various countries, and they might have created various subsidies or individually independently running shows. They are actually having a multi national presence, and these companies may have some competitive advantage inherently. Okay, and this is one interesting concept from a renowned investor, Mr. Warren Buffett. And as sir says that if a company got a very strong moat, and that company may have slightly higher valuation, and that company is actually good from a longer term perspective. Why? Because that the moat is in simple, it is like a competitive advantage. I'll give you an example. See, whenever we think of buying cold drinks, okay, we don't say it as a cold drinks. Rather, it's most often used along with Coca-Cola. Am I right? The Coca-Cola is having a fair share of the cold drinks market there. Like, let's take a company from India, which most of us may be aware of it. That I can say Nestle. The product what I talk here is the Maggie, which is the noodles. Although you see there was a bit of difficulty between 2014, 15, 16, they've been questioned by various angles. They were in fact temporarily stopped the productions and sales, but they were able to capture the whole market because the Maggie is something which is emotionally connected. So they don't just sell the product, no, they buy their target audience. So it connects through emotions. So such companies, for an outsider to compete noodle business, not that easy. It's not that easy to take noodles business from Nestle. ITC tried it, Patanjali tried it, but they've not been so successful because it's Maggie, it's not just noodle. So it's not that easy. Such a competitive advantage they can establish. Okay, and then naturally such business are very attractive, right? A strong balance sheet. Look, the business can be classified in two forms: professionals driven company, owners driven company. Owners driven companies may have some influence of owners, and such companies uh, slightly difficult to bet on their numbers, but the MNCs companies are typically driven by the professionals, okay, and the multinational, because the parent company may be sitting in abroad, maybe in UK, maybe in US, maybe in France, maybe in Singapore. It can be from any company, but they are also operating in India, right? So these subsidy companies may have a responsibility of keeping up certain metrics, so they know how to keep the healthy balance sheets. So I'm not talking about all MNCs are justifiable to invest, but in general, MNCs are known for keeping their balance sheets good. I mean, the kind of debt metrics, the kind of intangible assets they maintain, the kind of provisions they put in place, the kind of the disclosures with the non-balance, I mean, off-balance sheet records. They know how to keep this balance sheet crystal clear in a way that even a common man can understand, make sense out of it. So they are pretty transparent, is what I'm trying. We can rely more on their numbers, because they are not just answering this to the regulators. They have to answer their parent company as well, and so they may have a fair amount of transparency into the picture. And of course, high return on invested capital. See, the Colgate, Britannia, okay, and Nestle, these companies exist for more than 100 years, am I right? These companies still having a visible growth. Their still return on invested capitals are quite high. So the return on invested capital is one valuation metric which will helps you to justify whether it's a good or bad company. If you want to know details of those fundamentals, stay tuned. Towards the end of the video, I can tell you how you can actually learn those things and master yourself. But at this moment, for you, what it is needed is return on investment, and invested capital is a one fundamental metric which can help you to justify whether the company operating ability is good or not. Am I right? The operational revenues, that growth aspects is what it is talking about. The last but not least, that's very important thing, which is corporate governance, because these companies able to assure very transparent ecosystem, like their the management salary in check, and then the kind of the consistency in reporting, and the numbers will be very well audited, and the independent directors are truly independent. Like if it is owner driven company, you surprised to see that the independent directors are from the maybe the distance relation of someone, or like the independent directors are also acknowledges the executive directors, whatever they say. So we just want, whereas the professional driven companies, you see sometime the ex judge or some renowned people taking part of it, and that justifies the independent directors. So they are known for governance. So what it means, put together all five means what? Number one, it is actually sustainable, scalable, visible growth, and reliable. So what? Such companies are really good, and such companies is what investors wants, because investors not only looking for return on investment. If you think return on investment is the only factor for the investors, then you are so wrong, because investors want the capital to be protected, because they want at any cost this money to be back for them, and on top of it, if return is there, it is fair, am I right? And so they loves it. So these companies may be at their first choice to buy, and if it is slightly expensive, they don't mind, because they are not rational when they take this company. They even become irrational of acquiring this company. Very rarely these companies comes at affordable price. So but when such thing happen, make use of it. That's an added advantage. But you can't time the market, or you can't be quite waiting for such opportunities. So make sure that it is still good to stay invested in this company, but we have to keep reviewing them. We have to make sure that the balance sheet is as expected, but not much of doubt with a company who had their shows for last 50 100 years, but we still need to review it. But having seen their 100 years of performance, just because the P ratio is high with high visible growth rate, you don't have to keep quiet. You can sometime confidently start investing in it. See, just instead of investing in an unknown company, merely speculating that this will become a multi-bagger, for a peace of mind, invest in such a lovely good company, maybe with slightly higher valuation, no problem, but you get a peace of mind. So these companies works beautifully at various times. And the idea of this particular exercise is because that EQSIS Invest, as I already told you, if not, no, I'll just give you a quick glance about it. Okay, if you're new to EQSIS Invest, what I do is I'll take up this. Just go to equisis.com, and if you see investing, and this is a very simple tool. In 3 click, it can help your investment done. Like, in a matter of 5-10 minutes, you can do your monthly investments in stock market without much of your efforts. So in 1 click, you get a list of stocks. In the second click, you can review them if you are interested, and then in third click, you can trade it if you have a broker link to it. If not, you get an email, you can trade by them. But Morgan, how does it work, Morgan? Let's say it comes with a very nominal fee. So let's say you wish to invest for, no, I can take it as low as possible. Let's say 5,000. You wish to invest for 5,000 rupees. With this, you are starting now and you are subscribing and everything is done. Okay. And then if you, when you log into this particular portal, it tells you that, let's say I am changing this to 5,000. But here you don't have to do anything, because by default, if you say 5,000, then it will by default set as 5,000. So it says like 5,000 rupees. It is inviting me. And if I click on one button, it is giving me a list of stocks that I can actually buy for 5,000 rupees. So NMDC 2 shares, Dabur, Infosys, Reliance. By any chance, if I wish to invest more, okay, now by any chance, if I wish to invest more, let's say about 30,000 rupees, okay, the 30,000 rupees, the number of shares it actually recommends are more, because then it gets well balanced and diversified, and we get stocks from various sectors, various natures of the company, so that from a longer term perspective, everything is taken care. So NMDC, Marico, Dabur, ICICI, Infosys, Kotak Bank, HDFC, Reliance, Asian Paints, like few more stocks may also be there on the list. Let me take a quick list of it. But EQSIS, you find these companies. Okay, this may be based on various factors and ratings, get circulated and recommended to our the clients, and based on their portfolio diversification, the following months will also get recommended. But if you look at these stocks, in general, they are having a very high P's. You can easily notice now these P's are very high. Am I right? The companies like IOC, NMDC, the P's are actually low. We just got these two companies because these two companies, we have a very strong. We have expectation, but market expectation is low. We see that these companies can give a good valuation from longer term perspective. But if you look at the companies from TCS, Colpal, Divis Lab, Britannia, Dabur, Marico, HUL, and especially coming to the last one, which you see this, the Pidilite and Asian Paints, they are pretty expensive. Am I right? They their P ratio seems to be unjustifiable. But let me tell you one thing: these guys got a very stable business. Their numbers are quite consistent about it. So if you wait for a good day to invest, you will never find the day. The good day is to invest today. But Murugan, does it justify 95? Sir, not today. Even 5 years before, these guys got a very high P. Of course, the recent last 5 years, there is a slight uptick in the P ratio because the market is also slightly high and the market P is also slightly trading. But these guys are always on the top list of the P ratios, not just today, even 5 years before, 10 years before, these guys are actually quoting at a high P. So what you need to do as an investor is, we are not timing the market to make some short-term gains of it. We need to make sure that these guys can sustain the PE or not. That's very important. If not, they can sustain the 95 PE, even if it is about 60, 70 PE, but they have to give me the good growth in the sales, right? Good growth in the profits. And they have to make, if these things are happening, these P ratios become immaterial. Am I right? Even if the P ratio is 5 years down the line, even if it becomes 30, whereas the sales growth have increased by, let's say 20 folds or 30 fold, then no problem, because the underlying earnings have become. So now we are concerned about, can this company grow for next 30 years, 40 years, next 20 years, next 10 years, for that my investment tenure. If you look at the EQSIS Invest, most of the companies are actually from Indian MNCs, and we also have foreign MNCs, and of course the local MNCs, local companies is also into the picture. I mean, the local company, like their origin is from India and their existence in India, they are operating only in India. Whereas the Indian MNCs, like their origin is from India, but they also have presence in other countries. See, it is not all MNCs are actually good. Some MNCs have tried; they were not able to sustain. Like, Bharti Airtel. Bharti Airtel as a company into the telecommunication today, we may also have some. Sooner or later, we may also add into the list. But the point is, till date, their records, their kind of debt levels, making us to stay away from that. But going forward, the kind of duopoly they are trying to build in Indian market with Reliance and Bharti Airtel, Vodafone, I don't know to what extent they can come into the picture. That becomes a kind of commodity business, but only two player or three player still gives them a good margin. Let's see that later. But they tried South African business sometime back when they got a best times, but they're not able to successfully. So these companies for about 50, 60 years were able to operate consistently in various countries, deserves it. Yeah. So what next? So if you have any interesting companies, if you want to say anything about it, kindly post it in the comment section. And now from your perspective and why it is. And number two is if you want to learn more and take up a fundamental training program, definitely it will be very useful. If you want to know where it is, what you guys can do is just go to equisis.com. Just go to equisis.com, and then you see training underneath. If you're a beginner, take up the beginner level program, okay, because that's good for trader, investor, beginner to know the terms. That's good for all the content to a reasonable extent. But if you want to specialize something like Murugan, I know the basic stuff, but I'm specifically looking for a fundamental analysis training program. You can choose this fundamental training program. Remember, I'm not the one who currently practices the details of fundamentals, although I'm hosting the video. We have a Shripati from a team member may be the person who gonna address you all. But believe me, that will be a very interesting and very informative session. You guys can just a matter of one day, a weekend session, just cost you about 4,000 rupees. A live interactive session, not a pre-recorded session. That's come very interesting. So worth trying it if you are really interested in taking up the training aspect of it. Or if you want an investing guidance, like if you want to invest in shares like with a peace of mind, and if you wish to have our own recommendations, or you want some the tool which makes up your portfolio well and reminds you well and stay invested from a longer term perspective, then again go to the EQSIS website, and you see a menu called investing. Hit on investing button, and of course here you can actually start it. It just cost you about 999 for a year, am I right? And even you can invest 50,000 every week, or even every month, let's say. And that's how it is very powerful. So let's say, and if you want to invest even 50,000 or even 5,000, we just start very simple pricing. But if you wish to have a coupon for, because you are seeing this video till this minute, so not just like the content, so you should be motivated for with a little more coupon if you're interested. Go and check the description link, and you must be seeing. But this coupon may not valid for a long run, so it may be valid for about 3 or 4 days. If you find this video is very good, and if you want such videos, go and check out the playlist, because in our playlist we have recently posted videos, quite a bit videos with respect to investing, like the price versus quality, the dividend paying stocks, and a lot of other stocks being discussed now. So check out the other videos as well in the same playlist. Finds it very interesting. And if you want the active coupons, but you see this bit late, so what you can do is go and check out any recent videos being published. There also you can find some interesting coupons. Hope you found it very interesting, and thanks for being with us.